Imagine deliberately burning $46 million in cash in a single year.
That's a casual 46 million.
Right. Just setting it on fire, essentially, just to give your customers the illusion of an endless closet.
That's a bold strategy.
It's wild. But today, we are doing a deep dive into how a company basically bought its way out of a subscriber crisis and why the financial hangover from that massive gamble is forcing them to completely rewrite their business model.
Yeah, they really had to pivot hard.
For you listening, we're pulling this apart using a fresh stack of financial documents from Rent the Runway. We've got their SEC Form 10-K that was filed on April 14th, 2026, alongside their Q4 and full year 2025 earnings press release, and the transcript from that Q4 2026 earnings call.
Our mission today is to really decode how a business built on this, logistics-heavy, physical, product-like shipping luxury dresses in huge winter coats back and forth across the country, how they're trying to actually survive the modern subscription economy.
Yeah, because it's not easy.
No, not at all. They're leaning into this massive inventory gamble. They're deploying artificial intelligence to solve operational bottlenecks, and frankly, desperately launching new revenue streams just to make the math work.
Okay, let's unpack this. Because Rent the Runway just pulled off a massive turnaround in subscriber growth. Like, the user numbers are striking. But the financial mechanics running underneath that growth, the gears actually turning the business, they are shifting radically right now.
Oh, absolutely.
It is a completely different company than it was a year ago.
If we connect this to the bigger picture, this isn't just a story about high-end fashion. It really is a masterclass in the harsh realities of free cash flow in the modern retail landscape.
Right.
We're basically looking at a real-time case study of what it actually costs to buy a customer's loyalty today.
And, the extreme lengths a company has to go to keep that loyalty without completely bankrupting itself in the process. Let's start right there, actually, with the loyalty aspect. Because to understand where Rent the Runway is heading in 2026, you really have to understand the massive, incredibly expensive bet they made in 2025.
Big inventory push.
Yeah. They essentially looked at their subscriber base, realized they were stagnating, they needed to ignite growth, and they decided the only way out was to basically buy their way to a better customer experience.
Yeah, they doubled down.
They went out and made the largest inventory investment in the company's entire history.
And, it was a highly calculated risk. When you look at the Q4 data from 2025, you have to admit the strategy undeniably worked.
It really did.
They ended the fiscal year with nearly 144,000 active subscribers. That's a 20% increase year over year.
Which is huge.
It is. But raw subscriber counts can be kind of deceiving if those users are, on the verge of churning. The more telling metric here is how those subscribers are actually feeling about the service.
Right, the satisfaction score.
Exactly. Their subscription net promoter score, which is basically the gold standard for measuring customer satisfaction, it grew 39% year over year.
The documents actually note that their net promoter score has tripled since 2022.
Tripled? That's just...
It's crazy. For a mature subscription service, tripling your customer satisfaction is a staggering leap. And you can see that satisfaction translating directly into behavioral changes. Like, the average subscriber is visiting the app 15 times a month right now.
15 times. Think about that.
That's almost a 50% increase from 2024. People are basically treating a clothing rental app like a daily social media habit, like they're checking Instagram or something.
Yeah, just mindlessly scrolling the closet.
Exactly. And crucially, cancellations specifically tied to inventory issues. So, people quitting because they just couldn't find what they wanted, those dropped by 7.6% in the fourth quarter.
Which really validates the core thesis their management team was operating under, right? If you want higher customer loyalty, you just have to provide overwhelming choice. When the digital closet feels infinitely full, the customer doesn't leave.
It's exactly what Netflix did in the 2010s.
Totally.
If your streaming service is losing people, you just borrow a mountain of cash and buy up every blockbuster movie and hit TV show you can get your hands on.
Overwhelm them with content.
Right. You overwhelm the user with so much high-quality choice that they become completely addicted to the platform. But here's the mechanism that always catches up with you. Buying all those blockbusters, or in this case, designer dresses, it requires immense capital.
A lot of cash.
You have to take on debt or burn your cash reserves to fund that spending spree. How does that actually look on the balance sheet?
Well, that is the fundamental tension of the subscription model. You take a massive financial hit up front to acquire the most valuable long-term asset you can have, which is an engaged subscriber.
Yeah.
The underlying logic here is that subscriber growth is highly accretive to free cash flow over the long run.
Let's break down that mechanism for the listener, though, because accretive to free cash flow sounds like Wall Street magic.
Fair enough.
My reading of this is that the upfront cost is brutal, but the maintenance cost is cheap. Is that right?
Precisely. Yeah, to build the massive closet that attracts those 144,000 people, you have to spend tens of millions of dollars buying brand new inventory at wholesale prices.
Which is a massive capital expenditure.
Huge. However, once those subscribers are locked in and paying their monthly fee, your expenses drop dramatically.
Yeah.
You only need to spend cash to, replace the occasional damaged item or maybe refresh some seasonal trends.
Ooh.
Because replacing a torn dress is just a fraction of the cost of outfitting a massive warehouse from scratch. So they basically accepted a brutal cash burn in 2025 to secure a recurring revenue stream for 2026 and beyond.
So what does this all mean? Which brings us to the financial reality of this strategy. Because when you look at the Q4 and full year 2025 financials, the true cost of this growth is, it's kind of hidden behind some very clever accounting maneuvers.
It's very clever.
On the surface, the top line numbers look like a total victory. Q4 revenue hit a record $91.7 million. That's up 20% year over year, beating Wall Street expectations by over $15 million.
Massive beat.
And their earnings per share came in at -4 cents, which absolutely crushed the analyst consensus. They had braced for -$3.97.
It looks fantastic until you lift the hood on how much cash actually left the building.
Right. Because when you look at the free cash flow metric for fiscal year 2025, it plummeted to -$46 million.
Yeah.
And just for context, the year before, they were only at -$7.2 million. So they deliberately burned an extra $39 million directly tied to that huge inventory buy we were just talking about.
And this is where the financial mechanics become a matter of pure survival. Because when you're burning $46 million in cash a year to stock your warehouse, the debt clock is ticking very loudly.
Oh, I bet.
You owe money to lenders, and you simply do not have the liquidity to pay them back. So to avoid hitting a wall, Rent the Runway executed a strategic recapitalization.
You had to renegotiate.
Exactly. They went to the institutions they owed money to and basically renegotiated the terms. And through this, they managed to slash their total debt from about $319 million down to $120 million.
Let's be clear for everyone listening. A bank doesn't just forgive $200 million out of the goodness of its heart.
Definitely not.
A recapitalization means you are trading something. You're telling your lenders, look, we cannot pay you this cash, but we will give you equity in the company, or we'll alter the terms so you get a better payout down the line if you wipe this immediate debt off our books so we don't go under.
It's a survival mechanism, plain and simple. And it creates a very strange optical illusion on their income statement. Because they wiped out so much debt, accounting rules actually require them to record that as a $96.3 million gain.
Which is wild.
Right. So if you just glance at their bottom line for 2025, their net income looks positive at $22.6 million.
But they actually ran a deep operating loss. They spent more money running the business than they took in from customers.
Exactly.
It's basically financial engineering, keeping the optics bright while the core operations are still running at a deficit.
Which is why their projections for 2026 are the most important part of these documents. This is where the core mechanics of their business model fundamentally shift.
Okay.
For 2026, they are guiding for double-digit revenue growth. Now, you would think more revenue means more profit. However, they expect their adjusted EBITDA margins, which measures their core operating profitability, to actually drop to between 4% and 7%. Last year, it was 7.5%.
Wait, let me make sure I'm doing this math right. They are actively slashing their cash spend on new inventory for 2026, right?
Okay.
They're budgeting $45 to $50 million, down from almost $75 million last year.
Correct.
So if they are spending tens of millions less on clothes and their overall revenue is going up, why on earth are their profit margins dropping? That feels completely counterintuitive unless their ongoing operating costs are secretly skyrocketing.
What's fascinating here is understanding exactly how they are cutting that upfront spend. It all comes down to a program they call Share by RTR.
Okay, what is that?
They're fundamentally changing how they acquire clothes. Instead of buying inventory outright from a designer, which requires millions of dollars in cash upfront and counts as a capital expenditure, they're moving to a revenue share model with the brands.
Oh, So rather than writing a check for 1,000 dresses and owning them forever, Rent the Runway just acts as a host.
Right.
They list the dresses on their platform, and every time a customer rents one, they split that specific rental fee with the designer.
Exactly. Now, think about the downstream effects of that shift. On one hand, it's brilliant for your free cash flow.
Hmm.
You are no longer burning $46 million up front to stock the warehouse.
Hmm.
You get to keep your cash. But on the other hand, you are now obligated to share the ongoing revenue of those items in perpetuity. And those revenue share payments are classified as operating expenses.
Ah, there's the catch.
Yeah. So while your free cash flow improves because you stopped buying assets, your adjusted EBITDA margin shrinks because you are constantly paying out a cut of your monthly revenue to the brands. It's a strategic trade-off. They're stopping the immediate cash burn, but accepting significantly lower profit margins per item over the long haul.
But that creates a massive new problem, doesn't it? Because if you transition to a revenue share model and you slash your budget for buying brand new inventory by $25 million, you risk losing the very thing that saved you in 2025.
The overwhelming choice.
Exactly. How do you keep those users who are opening the app 15 times a month from getting bored if you aren't constantly pumping the app full of fresh, expensive clothes?
That is the existential challenge for them this year. You cannot just stop buying clothes without consequence. And their answer to this challenge, according to the CEO in the Q4 2026 earnings call, is artificial intelligence.
AI.
Of course, AI, right?
Yeah.
But if 2025 was about brute force inventory acquisition, 2026 is entirely about discovery.
I found their description of the endless e-commerce grid highly relatable. We all know the fatigue of online shopping. You search for a black dress, and you are presented with 50 pages of tiny, unorganized squares.
It's awful.
It is. You have to do the mental gymnastics of imagining what the clothes look like in the real world, how they fit, what shoes go with them. It's exhausting. And they're trying to kill that grid and replace it with an AI personal stylist that curates the experience the second you open the app.
The mechanism here is moving from item-based search to AI-driven outfit groupings. The algorithm basically analyzes the inventory they already have and curates an entire aesthetic.
Oh, nice.
Yeah, it shows you how a specific shirt transitions from an office setting to a weekend brunch. The AI does the heavy lifting of imagination, which, crucially, makes the older inventory look fresh and highly relevant to the user.
They're also rolling out what they call conversational search, which is a huge leap from traditional tagging. Instead of typing floral dress and getting thousands of random results, a user can type a full prompt like, what to wear to a destination wedding in Italy in June.
That's so specific.
Right, and the AI understands the context, the Mediterranean weather, the formal vibe, the current trends, and serves up a highly curated selection. And the data shows it's working. They launched a new search algorithm in February 2026, and it immediately boosted their subscription conversion rate by 10%.
They also introduced a quick arting feature to reduce friction, which now drives 28% of new favorites on the app. The goal is to make the user feel like the closet is constantly updating, simply by showing them different angles of what is already there.
Right.
But while the front-end user experience is flashy, the back-end application of AI is arguably much more critical to their survival.
Here's where it gets really interesting, because the AI isn't just a stylist, it's becoming their core operational engine. Like, yes, they are using AI-assisted coding to help their software developers push out app updates faster, but the physical application of AI inside their massive fulfillment centers is what changes the unit economics of the business.
We're talking about the reverse logistics here, specifically quality control.
Right. Just imagine the sheer volume of clothing returning to their warehouses every single day.
Yeah.
Millions of garments coming out of shipping bags. Historically, you had to rely entirely on human workers to inspect every single inch of a black dress to catch a loose thread, a missing button, or a faint stain.
Yeah, finding a tiny stain on a black dress by hand.
It's an incredibly slow, subjective bottleneck, but now they're deploying computer vision. The AI scans the garment instantly and objectively.
The underlying logic of this is a dual mandate for their AI strategy. On the consumer side, it increases the stickiness of the product. The user finds the perfect outfit faster and stays subscribed. But on the operational side, computer vision directly attacks their highest variable costs. By replacing a slow manual labor process with an instant scan, you dramatically speed up turnaround times. Furthermore, the AI dynamically prices the inventory based on demand to maximize yield.
So smart.
By squeezing every drop of value out of a dress and catching damage before it ruins a customer's experience, you don't need to buy as much new clothing to sustain the business.
But see, even if AI perfectly optimizes the warehouse and perfectly styles the user, Rent the Runway is still giving up a massive cut of their revenue to the brands under that new share by RTI model.
They are.
To survive that ongoing margin squeeze, they can't just rent clothes anymore. They have to invent entirely new ways to make money off you while you are inside the app.
Which brings us to the final major strategic shift in these documents, which is aggressive diversification. They recognize that acquiring a brand new customer online today is just exorbitant. Digital advertising rates are punishing. So if you have a cohort of 144,000 highly loyal customers who open your app every other day, the most financially efficient way to grow is to maximize the wallet share of the users you already have.
Meaning they are finding ways to charge you for things outside of the standard subscription tier.
Exactly.
For example, subscription add-ons. If you want to hold on to an item a little longer or rent an extra dress for a specific month, you just pay a supplemental fee. That specific add-on revenue grew 67% year over year in Q4.
Huge growth.
Yeah, but they're also stepping outside of rentals completely.
Yeah.
In March 2026, they launched a pilot for a traditional retail marketplace. They're selling wardrobe essentials, so shoes, basics, shapewear, to basically complete the rental look. Their internal surveys showed that 86% of members actually want to buy these supplementary items directly from Rent the Runway.
It's an attach rate strategy.
Yeah.
The logic is simple. If the AI has successfully convinced you to rent the gown for the gala, why should Amazon get the revenue for the shapewear and the shoes you need to wear underneath it?
Makes total sense.
They're capturing the entire transaction.
But they're monetizing more than just the wardrobe. They are launching an advertising network to leverage their high net worth user base, striking 360-degree brand partnerships with companies like Air France. And perhaps the most revealing tidbit about their need for cash, they are launching a B2B dry cleaning service.
That is a fascinating move because it's purely about monetizing a sunk cost.
Right.
To make clothing rental work at scale, Rent the Runway had to build massive, state-of-the-art reverse logistics and dry cleaning facilities. But when demand fluctuates or machines sit idle, they're losing money on that infrastructure.
The machines are just sitting there.
Exactly. So by renting out their cleaning capacity to other businesses like hotels or uniform providers, every outside garment they clean essentially becomes pure profit margin, which subsidizes their core business.
They're also completely restructuring how they market themselves. They're slashing their traditional paid ad budgets, stepping away from Google and Meta, and leaning heavily into what they call bold authenticity.
Right, the influencer push.
Yeah, they launched a creator program called Muse that generated 13 million impressions in Q4 alone, and they've built a grassroots network of over 1,000 local city ambassadors. But I have to push back here, though.
Okay, let's hear it.
Because looking at this list, they're renting dresses, they're selling shapewear, they're running an ad network for airlines, they're dry cleaning uniforms for other businesses, and they're managing 1,000 local influencers. Is this brilliant diversification, or is this a company throwing absolutely everything at the wall in a panic because the core rental margins are just too thin to survive on their own?
This raises an important question about what it actually means to be a platform in the modern economy. I mean, it might look like a lack of focus from the outside, but financially, they are ruthlessly leveraging the two tangible assets they possess.
Which are?
A highly captive audience and world-class logistics infrastructure. In a macroeconomic environment where capital is expensive and growth is hard, you just cannot afford to let any asset sit idle.
Fair point.
They're transitioning from being a singular rental service to being a multifaceted lifestyle and logistics platform. It's a highly complex transition, but given the realities of their debt and their profit margins, it's likely the only mathematical path to sustainable profitability.
It is a remarkable evolution when you lay the timeline out. In 2025, they looked at a shrinking user base and essentially borrowed millions to buy their way back to relevance, just flooding the zone with fresh inventory.
Yep.
They used that momentum to force their lenders into a massive debt restructuring, saving themselves from the brink. And now, in 2026, they are tightening the belt, slashing their inventory spend, and relying on AI to act as a personal stylist so the old clothes feel new again, while simultaneously launching a dozen side hustles to squeeze every drop of value out of their warehouses.
A lot to balance.
It really makes you think about the apps you open every single day. We just see the interface, but
Mhm.
underneath it, there are hidden financial mechanics, debt restructurings, margin calculations, and warehouse bottlenecks that actually dictate whether the service gets better or worse.
It does. And as we consider this pivot from the exhausting e-commerce grid to an era of AI-driven discovery, there is a broader cultural implication worth thinking about.
Oh, what's that?
Well, the goal of conversational search is to perfectly predict exactly what you should wear to that destination wedding in Italy.
Oh,
But as algorithms take over the role of our personal stylists, filtering our choices down to only what the data proves we will heart, we have to ask ourselves, are we actually discovering our own personal style, or are we simply wearing the data the AI has decided is mathematically best for us?
wow.
When the machine is perfectly optimized to eliminate friction, does a perfectly curated closet leave any room for a happy accident?
That is a phenomenal question to end on. The entire goal of this technology is to make sure you never stare at your closet and feel that frustration of having nothing to wear. But, maybe wrestling with that frustration is exactly how we figure out who we actually want to be. Thank you for joining us on this deep dive into the business of fashion. Keep questioning the systems, the financial strategies, and the algorithms shaping your daily life. We'll catch you next time.